Behind the counter and beyond the menu boards, the fast food industry's real engine is real estate, especially at McDonald's. Harry Sonneborn, McDonald's first CFO, made it clear decades ago. The company's real business is collecting rent, not just flipping burgers. This rent-based model, detailed in Wall Street Survivor, has shaped every part of how McDonald's and its competitors operate. Here's how it works in practice. McDonald's owns about 45% of the land and 70% of the buildings at its 36,000-plus locations worldwide. The company's real estate holdings are valued at around $42 billion, making up about 80% of its total assets. Instead of relying solely on food sales, McDonald's corporate collects rent from franchisees, who operate most locations. In 2021, McDonald's brought in $13.1 billion from franchisees, with $8.4 billion, about 62% of its total revenue, coming directly from rent. The rent typically ranges from 8% to 15% of a franchisee's gross sales, according to Investopedia and Your Story. This steady income insulates McDonald's from the ups and downs of the fast food market. For franchisees, the financial commitment is steep from day one. Opening a McDonald's usually requires $1 to $2 million upfront. That includes a $45,000 franchise fee, about $1.5 million for equipment, which must be purchased from approved vendors, and $500,000 in working capital. After securing the location, franchisees pay McDonald's 4 to 5% of gross sales as royalties, plus another 8 to 15% in rent. Once labor, food, and other expenses are paid, franchisees average about $150,000 in annual profit per location. Meanwhile, McDonald's corporate nets around $290,000 per store in pure profit from rent and fees alone. The company's approach to real estate is methodical. McDonald's real estate team studies traffic patterns and demographics before buying land, often securing prime corners years before any restaurant is built. The payoff can be enormous. For example, a Chicago lot purchased for $60,000 in 1955 now generates $1.5 million in annual rent. Corporate sometimes shifts properties between subsidiaries, inflating book values while keeping ownership in-house. This internal movement means your neighborhood McDonald's might have changed hands on paper several times, though it's always under corporate control. Once a franchisee is in, the lease terms are long and demanding. Most leases run for 20 years with automatic extensions, locking owners into decades of payments. Rent starts around $22,000 per month, but often climbs each year. In high-cost markets like California, some franchisees pay more than $40,000 a month just to use corporate-owned land and buildings. These rents can eat up 10 to 15% of total sales, which is much higher than what most independent restaurant tenants face. The risks are real for local owners. A Texas franchisee shared that he pays McDonald's $396,000 a year in rent before making any profit. Another spent $1.8 million renovating an old site, only to see corporate approve a new McDonald's just half a mile away. If sales dip or costs rise, corporate can terminate a lease and resell the location to a new operator, collecting another $45,000 franchise fee in the process. Franchisees have little leverage. If they walk away, they lose their entire investment. McDonald's profits from every angle. Franchisees are required to buy everything from napkins to point-of-sale systems through corporate-approved suppliers, often at a markup. Audits have found corporate making over 100% profit on some of these supplies. Equipment is leased through McDonald's own financing arm at above-market rates. Loyalty program redemptions come out of the franchisee's pocket, with corporate keeping the full purchase price while local owners cover the cost of free food. Several franchisee groups have alleged exploitative practices, according to Retail Wire, claiming that corporate policies and accounting methods stack the deck against local operators. The company's real estate strategy explains a lot about the fast food landscape. McDonald's operates in tiny towns with few customers because it owns the land, turning even underperforming locations into steady rent generators. Frequent rebuilds and renovations aren't just about keeping up appearances. New buildings allow corporate to justify higher rents. When multiple McDonald's pop up in the same area, it's often because corporate owns the surrounding real estate, using the restaurant as an anchor to boost the value of nearby properties. Other fast food giants have followed McDonald's lead, though few match its scale. Burger King owns about 10% of its locations outright, and leases another 25% to franchisees. Yum Brands, which includes KFC and Taco Bell, uses a similar model, but with less direct control, resulting in lower profitability. Starbucks resisted this approach for years, but now owns about half of its U.S. locations. The more real estate a company owns, the more predictable its earnings become, no matter how food trends shift. Franchisees increasingly push back. Some owner groups calculate that McDonald's extracts over 40% of each location's revenue through rent, royalties, and required purchases before even considering food costs. Others argue that McDonald's makes more money selling franchises and collecting rent than it does running company-owned stores. These tensions have led to lawsuits and public disputes, with franchisees accusing corporate of manipulating accounting to inflate rent percentages and charging for unnecessary renovations and tech upgrades. The pandemic put this model under a microscope. With dining rooms closed, franchisees asked for rent relief, but McDonald's only offered temporary deferrals, demanding back payments with interest later on. Some franchisees went bankrupt, while corporate posted record profits thanks to a surge in delivery orders. The structure of the business meant that rent and royalty streams kept flowing to corporate, regardless of local struggles. Rural and small-town franchisees often feel the most pressure. As sales decline, corporate rarely adjusts rent percentages downward. In one Nebraska location, rent jumped from 8% to 12% of sales after a property reassessment, even as customer counts dropped. Owners say the system expects underperforming stores to subsidize high-traffic urban locations, using the rent structure to keep overall revenue stable for the corporation. Commercial real estate experts often point to McDonald's as a model of efficiency. The company boasts a 99.5% occupancy rate across its properties, a figure most traditional landlords can only dream of. This stability comes from the strict requirements and financial commitments placed on franchisees, ensuring that rent keeps coming in even during industry downturns. This approach also explains why fast food chains continue to expand, even as sales per location stagnate. For corporate, opening new franchises is always profitable. The $45,000 franchise fee, equipment sales, and guaranteed rent outweigh any risks of market oversaturation. That's why you might see several McDonald's in the same town. Corporate profits from each one's existence, regardless of whether there's enough demand for all of them. The rise of ghost kitchens takes this real estate strategy to a new level. McDonald's and other chains now operate delivery-only locations that pay corporate rent without needing seating areas or drive-thrus. These virtual restaurants have higher margins and lower overhead, maximizing returns on real estate investments. Some analysts expect future growth to come mainly from these hidden kitchens, as traditional locations face slower growth. Every aspect of the McDonald's experience traces back to this real estate model. Uniform building designs are easy to mass-produce on corporate-owned lots. Streamlined menus maximize kitchen output per square foot. Even the iconic golden arches serve as landmarks that boost property values as much as they attract customers. Ray Kroc's insight was simple: land appreciates, food does not. That principle still drives the business today. But this relentless focus on real estate and efficiency comes at a cost. The drive for uniformity and cost savings has reshaped the look and feel of fast food restaurants everywhere. The next time you walk into a newly built location, you might notice they all seem to share the same bland, boxy design. That's not a coincidence. It's a direct result of corporate priorities. And it sets the stage for a new question. Across the fast food landscape, memorable new kind of sameness has taken hold. What many call the Bland Box Takeover. Walk into a recently built McDonald's, Burger King, or Wendy's, and you'll notice the same gray walls, neutral tones, and flat-panel digital menus. Gone are the days of playful arches, castle turrets, or cozy red roofs. Now, nearly every new location follows a stripped-down corporate prototype, with exterior design elements reduced by 40% to cut costs, as shown in decision documents from Restaurants Canada. The result is a sea of minimalist boxes, each designed for efficiency and consistency rather than personality. This transformation didn't happen overnight. In the 1980s, fast food brands began moving towards standardized designs to save money and simplify operations. The trend accelerated as digital menu boards replaced the unique facades and playful interiors of previous decades. According to a Retail Insider review of the Canadian market, these changes were driven by the need for speed and scalability. Today, construction documents reveal that generic layouts cost about 30% less to build than the themed restaurants of the 1990s, and maintenance expenses are 40% lower on average. Standardization allows chains to deploy new locations in under 3 months, compared to a year for custom builds, a clear advantage in a competitive market where every week counts. Franchise agreements now mandate strict adherence to corporate design standards. Owners must follow detailed guidelines down to the paint color and floor tile. One Burger King operator was fined $15,000 for using the wrong shade of gray on the exterior. McDonald's requires identical kitchen layouts worldwide, even when local staff say it's less efficient for their market. This uniformity ensures brand recognition, but comes at the expense of architectural diversity and local adaptation. Inside, the changes are just as stark. Classic features like playgrounds, jukeboxes, and booth seating have disappeared. Hard chairs replace booths to discourage lingering, making way for faster turnover and higher hourly sales. Some locations have removed trash cans entirely, shifting waste management to staff to streamline cleaning and reduce labor costs. The focus is on throughput, how many customers can be served per hour, not on creating a welcoming environment. Digital menus play a major role in the modern fast food experience. Chains can adjust prices in real time, raising costs during peak hours and rolling out limited-time offers to create artificial scarcity. Menu engineering pushes higher-margin items through strategic placement, a tactic that wasn't possible with static boards. These changes might make operations more efficient, but they also contribute to a sense of detachment and impersonality. The move toward automation further erodes the human element. Self-service kiosks have replaced many cashiers, upselling automatically with every order. In the kitchen, staff often work behind frosted glass, minimizing direct interaction with customers. Some drive-thrus now use AI voice ordering, removing even the basic exchange between worker and guest. In a leaked presentation, a McDonald's executive described employees as the most unpredictable cost center, a sentiment that explains the push to automate wherever possible. Some chains have taken this approach to the extreme. In California, a Chick-fil-A location was built without any dining seats, offering only pickup shelves and a drive-thru. Dark kitchen models, restaurants that exist solely to fulfill app orders, are becoming more common. One Burger King in Brooklyn consists only of vending machines and a QR code, with no staff visible to customers. The physical space itself has become secondary to the need for efficiency. Customers have noticed. The American Customer Satisfaction Index, ACSI, found that satisfaction scores fall by 15% when locations replace unique designs with generic layouts. The 2024 ACSI report also links declining consumer excitement to the lack of personality in new stores. Many people miss the playful features and memorable architecture that once defined their favorite fast food spots. Review sites consistently show higher ratings for older locations that retain traditional designs, and some travelers seek out vintage Pizza Huts or Wendy's for nostalgia and photos. Franchisees have little choice in the matter. Lease agreements often require renovations every decade, and any deviation from the approved design can result in fines or even the loss of the franchise. Attempts to preserve classic elements, like a Whataburger owner who kept a 1970s orange roof, are rare and usually short-lived. As leases come up for renewal, holdouts are forced to conform or risk losing their business. The psychological impact of these changes is significant. Studies show that colorful, playful environments boost mood and satisfaction, yet fast food chains continue to opt for sterile, minimalist spaces. One marketing professor refers to this as the IKEA effect, where bland surroundings train customers to accept a mediocre experience as normal. The food might be the same, but the sense of occasion and fun is gone. For younger generations, the transformation is almost complete. Teenagers today are unlikely to remember birthday parties under bright arches or afternoons spent in themed playplaces. Now, fast food is just another transaction, efficient but forgettable. The industry's focus on maximizing throughput has come at the expense of the magic that once made these places special. Corporate surveys often frame the new designs as a response to customer demand for cleanliness and convenience. However, these surveys rarely ask about the loss of charm or personality. The real story appears in the data. Locations that retain some classic elements outperform the new sterile boxes by 15% in customer satisfaction, according to ACSI scores. Yet, with profitability as the guiding principle, satisfaction often takes a back seat. Even so-called retro locations are typically just facades. Chains sometimes build replicas of old designs as marketing stunts, but behind the vintage signage and neon, the interiors are identical to every other store: gray walls, digital menus, and streamlined kitchens. Energy-saving measures, like turning off neon signs during the day, further diminish any sense of authenticity. This standardization is now a global phenomenon. A new McDonald's in Dubai looks almost identical to one in Des Moines. While menus may adapt slightly to local tastes, the buildings do not. Corporate leaders determined that maintaining regional architectural diversity was too costly. A single prototype now serves every market, maximizing profit per square foot. Some chains resist the trend in small ways. Chick-fil-A occasionally uses brick exteriors, and Shake Shack's modern designs feel intentional rather than purely cost-driven. But the overall direction is clear. The industry is moving toward total homogenization. Within a decade, nearly every fast food restaurant may look and feel like every other, a landscape of gray boxes and glowing screens. For many customers, this shift means the loss of something intangible. The excitement, the sense of place, and the little touches that made fast food an experience rather than just a meal have faded. Kids no longer beg to visit for the playground or the cool building. Instead, fast food has become another quick stop between activities, a transaction stripped of wonder. Yet, not every brand has followed this path to the letter. One chain stands out by holding on to its quirky identity while still thriving in a market obsessed with efficiency. While most competitors have embraced the bland box model and relentless price hikes, this outlier manages to keep costs down, menus fresh, and customers engaged. Their approach raises an important question about what's really possible in fast food, and whether the industry's current direction is the only way forward. Taco Bell, the fast food rebel. Taco Bell stands out as the fast food industry's most unconventional player. While competitors steadily push prices higher and shrink their menus, Taco Bell takes a different route, focusing on value and innovation, and doing it with a consistency that's rare in the business.